this unit, we have covered a number of topics related to use of leverage to increase the earnings of the equity shareholders, and then how EBIT, varying levels of EBIT, have an impact on the earning per share of the equity shareholders. Okay. Now, when we study the capital structure theories, we will be seeing in what ways and how the financing decision of the firm has an impact on the value of the firm. Okay. Now, when I talk about the value of a firm, then I am talking about two variables that have an impact on the value of the firm. One is EBIT. As all of you know, EBIT is earnings before interest and taxes, and the overall cost of capital. Okay. Overall cost of capital or weighted average cost of capital is the average of the individual specific cost of different sources of finance in your capital structure. When we calculate the value of firm, it is EBIT upon AO. Okay. So, on what factors does EBIT depend? It depends on the investment decisions taken by the firm. In which projects are you investing? In which machineries are you investing? That has a long-term impact on the earnings capacity of the firm and hence the EBIT of the firm. So, EBIT of the firm is dependent on the investment decisions, that is the capital budgeting decisions taken by the firm. On the other hand, cost of capital, as I told you, is the weighted average of the individual sources of capital, is dependent on the financing decisions taken by the firm. Financing decisions, that is how much of debt and how much of equity should we have in our capital structure. आपने cost of capital का अलग से unit करा है. You know that all the sources of finance, whether they are explicit sources or implicit sources, even if the promoter of the company is bringing his or her own capital, that is also involving an opportunity cost. So all sources of finance have some cost involved. So we make a cost benefit analysis and narrow down on the appropriate sources of finance for the company. Okay. If I talk about the EBIT of the company, again income statement हमने करी है. There are three layers in which the EBIT is divided, or three parties among which the EBIT is divided. At the foremost are the debt holders, because the first thing that you reduce from EBIT is the interest payment. So the first claim on EBIT is of the debt holders. Then again, secured and unsecured, both kind of creditors of the company are covered under this segment, under the interest payments. After that, after payment of interest on debt, you pay taxes. Okay, so which means the second party which is involved, which has a claim on the earnings of the firm, is the government. Okay, in form of taxes paid. And the third and the last claim in the form of dividend is of the shareholders. Then again, the preference shareholders, they get a lead over the equity shareholders in the claim on the earnings of the company. Okay. Now, Ultimately, when everything works out, all these claims are settlement, you have an earning per share in your hand, which will then impact the market value of the company. So, as we spoke about in the first unit, EPS, maximizing EPS is maximizing of profits, and maximizing NPS is maximizing the market value of the firm or maximizing the wealth of the shareholders, which is, we say, the ultimate objective of financial management. So the fund decision related to capital structure, all his all these decisions are having an ultimate impact on the market price of the share, that is the wealth of the shareholders. Okay, now again there are different schools of thought wherein different people have different opinions about the worth of capital structure decisions. That is what we'll be studying under the capital structure theories. Okay. To explain this relationship between capital structure, KO, which is the overall cost of capital, and valuation of the firm, you have four theories wherein they have contrasting views. Now, some theorists have an opinion that capital structure theories have an impact on value of the firm. Leverage used by the firm, leverage is fixed cost funds used by the firm, have an impact on value of the firm, while other theorists believe that this is an irrelevant decision. So you can see there are four theories before you. First is the net income approach. What does this say? It says yes, the capital structure has an impact on the value of the firm. So capital structure is a relevant decision for the firm. Net operating income. So net operating income already has a no in its nomenclature. So it says no. Capital structure does not have an impact on the value of the firm. The third approach, approach, is actually giving you a justification of the no, which the NOI approach has given. So we say it gives a operational justification or a behavioral justification as to how there is no impact of capital structure on the value of the firm. And the last school of thought here is a traditional approach. Traditional approach is a yes plus no approach. Okay, so it is a mix, a moderate approach which says to some extent capital structure has an impact on value of firm, and after a point of time after a point of leverage, after a point of debt financing, there is no further impact of leverage on the overall cost of capital. Okay, so let us take up each of the approaches one by one and see how do they impact the value of the firm. So we come to the assumptions first. These are the assumptions under all the four theories. The first assumption is that there are only two sources of finance, two sources of capital for the firm, either debt financing or equity financing. Then the assets of the firm remain unchanged during the decision period. 100% dividends are paid to the shareholders. Okay, so whatever earnings are available to the firm, it is not reinvesting, it is distributing the entire earnings to the equity shareholders. The EBIT is given, it is not changing during the decision making period. Risk is constant, there are no corporate taxes. Now this is something which is purely hypothetical. Okay, so you cannot avoid corporate taxes in real world, but here when we are explaining the theory, we take these assumptions. And investors have same subjective probability distribution, means they have same expectation about the EBIT in the future also. Okay, so all the investors are expecting the same future level of EBIT, and the firm has a perpetual life. Perpetual, all of you know, there is no immediate decision of, there is no expected decision of closing down the business. It will go on forever. Okay. Then we come to the first approach, which is the net income approach. As I told you, this approach says that capital structure decision is relevant for the firm. You use leverage. Leverage, you introduce a debt in your capital structure, and the value of the firm will improve because debt is assumed to be a cheaper source of finance as compared to equity, which to a large extent is actually the case also. We say that among all these sources of finance, it is the cost of equity which is the highest. So, cost of debt is assumed to be lower than the cost of equity. Again, as I told you, there are no taxes hypothetically, and the use of debt does not change. Please have a look at this point. Use of debt does not change the risk perception of the investors since the degree of leverage is increased to that extent. Now, what does this mean? Let's take a simple example. You are going to take a loan, say you're taking a car loan, and you go to PNB, and before approving the loan, they'll ask for your credit history. Now, all of you know that individual credit history is in form of a score. What is the name of that score? So, bank has to verify your credit history. It will see your credit score. Okay. What is the name nomenclature used for that score?
Civil
CIBIL
score.
score. Very good. So, individual rating is done by CIBIL score. Now, under that score, the firm sees what has been your credit history and how efficient have you been in making the payments, basically the interest payments on the previous loans taken by you. Now, as the number of loans increase, here I am talking about an individual, we can talk about a firm also. As the number of loans increase, the risk perception, that is the expected risk, the credit risk of that entity also increases. So, say for example, you got your first loan at 8%. The second loan will be at a rate which will be higher than this rate of interest. Again, that depends on the nature of loan that you have taken. But once you have an existing loan on your head, you are obviously a more risky proposition when the bank is approving a second or a third or a fourth loan. So with every successive loan, the risk increases. Okay. Now this I am talking about an individual. Same is the case for a firm also. Say when I invested in company A had 20% debt. Okay. So which means 80% equity holding fee, 20% debt. Over the years, this debt financing has increased to 50%. That is, debt equity ratio has increased to 1 is to 1. Now, this increased debt is actually an increased risk to the equity shareholders also. Because if the firm defaults on the payment of interest, then it will be taken to court and the court can order the winding up of the firm also. So the risk perception of the equity shareholders increase. It is increasing with successive leverage in the capital structure, with increased leverage in the capital structure. So what do they expect from the firm? They expect that now the firm will give them additional dividend. That is, more earnings will be distributed to equity shareholders to compensate them for the additional risk they are assuming. क्योंकि फाइनेंस में क्या फंडा होता है, हायर द रिस्क हायर इज द एक्सपेक्टेड रिटर्न. So if as an equity shareholder with increased debt I am assuming more risk from the firm, then I am also expecting a higher dividend from the firm. Okay, this is what happens practically, but the NI approach says that the equity shareholder is indifferent to any percentage of leverage used in the capital structure. Okay, so we are working on this assumption कि चाहे 20% leverage है, चाहे 50% है, चाहे 80% है, equity shareholder is not impacted by this. So according to NI approach, if the financial leverage increases, the overall cost of capital decreases and the value of the firm and the market price of equity share improves. Okay, as I told you, that value of the firm is EBIT by KO. तो जब लीवरेज इंक्रीज हो रही है तो आपका जो KO है वो फॉल कर रहा है. आपके फाइनेंसिंग डिसीजन से आपका ओवरऑल कॉस्ट ऑफ कैपिटल फॉल कर रहा है. इफ द डिनोमिनेटर फॉल्स, then the value of the firm will improve. Okay, so if we have to represent this graphically, this is how we represent it. We take the leverage, degree of leverage on the x-axis, and we take the cost of capital on the y-axis. We are assuming that cost of debt is lower than the cost of equity. Okay, so this is your cost of equity, this is your cost of debt, and this line in between is the overall cost of capital. So as the degree of leverage is increasing in the capital structure, say you're moving from 10% to 20 to 30 and so on, you can see that the overall cost of capital is falling. Okay, which means when you have zero leverage at this point, at the starting point, the overall cost of capital is equal to the cost of equity. Okay, when you keep on adding debt in your capital structure, your weighted average cost of capital is falling. Okay, now these two lines will never meet because there cannot be 100% debt firm. Okay, so that's not possible that any firm can work entirely on debt. So they come closer, but they do not meet KO and KD. But yes, with every addition of leverage to the capital structure, the overall cost of capital is falling, and hence the value of the firm will improve. Coming back, the financial leverage, I have explained this part to you. This is the graph which we have studied. So this portion shouldn't actually meet each other because you cannot have an 100% debt financed firm. Okay. So this is the next point that needs consideration under the net income approach. How do you calculate the cost of debt? Cost of debt वैसे भी आपने करा है. It is interest upon the market value of debt. Cost of equity under the NI approach is net income. Net income is your profit before taxes. बट यहाँ पर आप अज्यूम कर रहे हो देयर आर नो टैक्सेस, सो नेट इनकम इज बेसिकली योर अर्निंग्स अवेलेबल टू इक्विटी शेयर होल्डर्स, EAES, divided by the market value of equity. And weighted average cost, as I told you, value of firm is EBIT upon KO, which means KO is EBIT by D. Okay. So this is how we derive the values under the net income approach. I'm sorry. So we come to a question on the same, on the net income approach. So, I know I am, okay. This is the question on net income approach. Just have a look. The net operating income of a firm is 2 lakh. This is your EBIT. The overall capitalization rate is 10%. The firm is having 8%, 3 lakh equity shares. Sorry, this is NOI. I think I've taken both the questions same. Just give me a second, I'll add the question here. Okay. So here's the question. A company's expected EBIT is 3 lakh. The equity capitalization rate of the company is 10%, while debt has a rate of 8%, and the value of debt is 5 lakh. You have to find out the value of the firm and the overall cost of capital as per the NI approach. So let's start solving this question. The EBIT of firm is 3 lakh. The first claim is of the debt holder, so we pay the interest, which will come to 40,000, 8% of 5 lakh. So 2 lakh 60,000. Now, since there are no taxes, this is the net income of the equity shareholders. So to calculate the cost of equity, you take NI by, okay, to calculate the value, because you are given cost of equity. So to calculate the value of equity, we take NI by KE, which is 2,60,000 divided by 0.10, which gives you 26 lakh, and the value of debt is already given to you as 5 lakh. So overall value of firm is sum total of debt and equity, which comes to 31 lakh. Okay, so first part, find out the value of firm. Currently the market value of the firm is 31 lakh. Next step is to calculate the overall cost of capital. So the cost of capital will be EBIT by V, so which is given to you as 3 lakh and value is 31 lakh. Tell me how much is the answer coming to? Coming to 9.67. Okay, another way of calculating this is that you take the weight of debt in the capital structure D by V into cost of debt plus weight of equity E by V into cost of equity. You'll get the same answer, which is 9.67%. Okay, so this is how we calculate the overall cost of capital using the net income approach. Yeah, I hope this is clear to everyone. Please add um, some information to this question. You will have to calculate in the next parts. You will calculate first the overall cost of capital when the EBIT increases from 3 lakh to 8 lakhs, and next case will be when the EBIT falls from 3 lakh to 2 lakh 50,000. So what will be the impact on the overall cost of capital? Start calculating. Second part is when EBIT increases to 8 lakh, and third part of the question is when EBIT falls to 2 lakh 50,000. So how is the overall cost of capital impacted? All these steps are there on your screens. You just need to change the value of EBIT. The remaining steps are the same. Okay, so this is for the second part. Solve. Others also solve. Then I'll check the answer. Okay, you're giving 9.87 for 2,50,000. Yes. 2,50,000 or 9.61. Okay. So EBIT increases to 8 lakh. It is 9.87. And when it is falling to 2,50,000, it is 9.61. Okay. Are others also getting this answer? So with a change in EBIT. If EBIT is increasing, if the numerator is increasing, then your overall cost of capital is also increasing. While if it is falling, then the overall cost of capital is also falling. Okay. So this is how you calculate the value of firm under the EBIT constraints as per the NI approach. Any question, anyone?